Awesome. Awesome. Well, thank you once again,
Yes,
everybody,
good
for
afternoon, everyone. Welcome. My name is Lisa Friedlander. I'm the CRO over here at Next, powered by Schulman Rogers. We're thrilled to have you at our November partner webinar brought to you by ScaleRedi and Stephanie Pitta. This is a topic we get all the time, startup financial planning. I mean, there is not a bigger topic to help provide good resources, whether you're fundraising, whether you're just launching, whether you're scaling, whether you're hiring. There is no time when startup fundraising, startup financial planning is not relevant. So we're really thrilled to have Stephanie here from ScaleRedi. Stephanie is a CPA and the founder of ScaleRedi Accounting Group. She is a seasoned CPA professional with over 14 years of experience in accounting and finance. She has dedicated her career to simplifying the financial process and providing startups with the knowledge and tools needed to succeed. Stephanie has helped numerous startups build robust financial foundations. Her expertise encompasses data accuracy, streamlined processes, modern technologies, and strategic planning. Her passion lies in empowering startups to navigate the complexities of financial planning with confidence. Again, we're really thrilled to have you, Stephanie, to share your insights and your expertise with this group, as it is an incredibly hot topic. And just a reminder, Stephanie's happy to answer questions as we go along. So feel free to chime in and or add your questions to the chat, and we will also reserve time at the end. So with that, Stephanie, I'd love to turn it over to you. Thank you so much for being here today.
awesome. Well, thank you, Lisa, for having me. I'm really excited to talk about financial planning today. And with that, I just want to let you guys know I do have a little bit of a cough. So if I put myself on mute, I apologize just ahead of time. But I know Farah's already gave us a little bit of, why he joined today. I would love to know, from the people that have joined recently, what brought you guys to this webinar today? Maybe Catherine, Ativa, Trisha, if you guys, or Jason, if you guys want to share.
Hi there. Good morning.
Hi, Catherine. Good morning.
Thank you so much to Lisa and also to you, Stephanie, for doing this. I am a startup founder and I'm very much in a place where I just don't know what I don't know. I've heard tons of horror stories about people who forgot to file a certain form and owed a bunch of taxes on their stock options. I've heard horror stories of people who maybe didn't spend down the right amount, and things like that. I have a C corporation. I would love to understand the difference between paying myself versus then also reinvesting my own money into my own company versus not paying myself at all, if that makes sense. Because I know that there's tax implications on that. And then just generally good strategies on spending down and financial planning more broadly from a C corporation perspective. Just happy to learn and absorb whatever I can.
Awesome. And for today, we may not cover necessarily, Catherine, like the C Corp implications as it relates to tax, but if there is any questions for you or anybody else that doesn't get answered today, happy to answer that offline. So I'm going to go ahead and share my screen. If you guys can just let me know if you can see it. Okay, perfect. So as you know, the topic for today, annual planning simplified, key essentials. So we'll be going over the annual planning process. Some of you may already have started the planning season. Some of you, may be in the process of starting. Please, I'm getting feedback. Not sure if.
Yeah, I heard that too. I think you're good now. Try again.
Okay. Yeah, looks like it got fixed. Perfect. Lisa already did an intro about myself, so I'm going to skip that and go right into essentially our agenda for today. So today we're going to review the 4 steps planning framework. And within this, we're going to cover first of all, essentially going from step one to the last step of your planning process. What are the things that you need to consider? So the first thing here that I have is a business review. You don't want to go into your planning process blind, right? You want to have understanding of what happened in the prior year. How did your strategies, landed during the year? You want to look at goal setting. So based on what you've learned, based on the strategies that you implemented in the prior year, and the ROI that you received from that, how are you going to change that for next year? Do you want to increase revenue by 10%? If so, how are your marketing and sales strategies going to play out based on that? We're going to do a little bit of a working session on budgeting and forecasting. Nothing too complex. We're going to keep it simple for this webinar. And then we're going to talk a little bit about reporting as well, which will be crucial. You spend a lot of time during planning season. You want to make sure that at the end you have a regular cadence for comparing your budget versus actual on a regular basis, making sure you're tracking performance and all of that. So why is the annual plan important? What is it and why is it important? For some people, the annual plan could be called different things. The operating plan, the budget plan. For the purpose of our call, we're defining it as a plan that defines the financial, physical, and human resources to be allocated to achieve your business goal for the next 12 months with a roadmap of how your team will get there. So you're going to have your underlying goals, and we're going to set different objectives and the milestones that it's going to help us get there over the next 12 months. And why is it important? Without a plan, you don't have, you don't provide visibility to your team, for yourself, for your stakeholders, your investor, your board. So you want to have a plan that outlines, what's your vision for the next 12 months for your company. It gives a clear understanding of how you're going to achieve your goals. If you do fundraising, it's going to give investor confidence of how you're going to get there. What are the milestones and how you're going to achieve that? It's going to increase accountability and ownership. If you're tracking it, if you have a plan, if you have somebody that owns it, it's going to increase accountability and transparency as well. And then you're going to have more accurate budgeting and forecasting. I see it too often where, a company might take the prior year's budget and just increase it by 5% across the board. We're going to increase revenue by 20%, but we're not sure what happened last year. And we're not sure, how expenses, we don't know the story behind the numbers. And we want to make sure that we know the stories behind the number. We have clear goals, and we have a clear understanding of our spend. And then, of course, it improves coordination between departments. Cross-department collaboration is essential, between your sales and marketing team and your ops team. You want to have open lines of communications because this is a team work. You collaborate across the team to be able to achieve your goals. So doing this exercise brings everybody together and brings everybody on the same page. So with that, the first point here of the 4 steps planning framework, the business review. So my recommendation is always, before we are going into, looking at next year, looking at our goals, what happened last year? What happened in the prior year? What have we learned from previous performance? So we want to review the prior year's financial statement, analyze it just to see what we've learned. If we did have a budget for the prior year, looking at our budget versus actuals and variance analysis to see, if we didn't meet the goals, why did we fall short? Or if we did, what worked really well? How did we do with our drivers and assumptions? Are those still reasonable? If we had an assumption that our churn rate was 5% or 10%, is that still relevant? How does that compare to our actuals for the year? So you want to have a solid understanding of where you're at in terms of your business. And then with that, you also want to examine areas of improvement. You know, I have some examples here, like in your sales and marketing strategies, operation processes, human resources capability, and of course, evaluating cash flow needs. You want to have a clear understanding of when you're going to need more funding. You know, what's your cash runway, and you know, what is your cash out date? Those are things that you know, the cash side of things keep founders up at night, and you want to make sure that, you know, by doing a good planning process and reviewing and having a good foundation there with your understanding, that's going to bring visibility. So with the next step here, goal setting, you want to have, you want to set specific goals and, you know, essentially set SMART goals for your business. And you know, I'm sure some of you are pretty familiar with what a SMART goals are, but I just want to bring it up here. So you want it to be specific, so clear and well-defined. So if you want to increase revenue by 10% or 20%, be specific, not just, you know, like increase revenue for the next year. You want to have a clear, defined goal there. You want it to be measurable and be able to track progress. So in terms of revenue, if we want to increase revenue 10%, we can measure that against our actuals and see how we're doing. You want it to be achievable, so realistic and attainable. So, you know, if you have limited resources and, you know, you can only invest X number of dollars into your sales and marketing machine, then you have to take that into consideration and see how much can I do with the resources that I have. And you want it to be relevant for your business. So you want to evaluate the stage you're in, whether you're in the product development phase or just launching your first pilot, whichever the stage you're in, you want to make sure it's relevant. And it's aligned with, you know, your investor expectation for your business. And then time bound. So in this case, you know, we want it to be within the next 12 months for the next year, because we're specifically talking about the annual plan, and we want it to be within that time frame. Some examples of some SMART goals could be, again, for revenue, for instance, increase revenue by 10%, extend cash runway through 2025. So you may need to set a goal that you might have to raise X number of dollars. And then also, you know, something in the operating expenses side of things, like reducing operating expenses by 15% within the next fiscal year. So you want it to be specific. And I actually, reading an article, I found this screenshot here, which I liked how it looked. And it's one of those project management tool where, you know, you have the goal, you have the date, and then somebody assigned to it, and you have, you know, these are essentially SMART goals. And of course, if you use like something like this, you can certainly track it within your project management tool, or you know, it could be within your financial reporting package as well. And then just a few things for the goal setting tips. You don't want to go overboard. You want to have a few simple goals, but you want it to be meaningful. You know, the goals, for instance, to increase revenue 10%, that would be very meaningful. It might require a lot of resources. It might require a lot of strategizing. So even though it might be one goal, it's going to take a lot from your team, and you want your team to be focused on, you know, on specific goals. So it is recommended typically, you know, maybe one to three goals in terms of, you know, just overall objective for the year. You want to identify the KPIs that can tie to your goals so you can track it on a regular cadence, whether you do it monthly, quarterly, and we'll talk a little bit about that as well. And you want to evaluate the approach that fits your company. Not every side fits all, so you want to evaluate, you know, what makes sense for your company and also be realistic. And then in terms of, you know, just when you're setting your KPIs, usually you might have, if you're a founder, you know, you probably have done a lot of research in the industry, you might have pretty good idea, what are some of the key KPIs that you need to track for the different areas. But I just put some examples here, and usually you display this within the dashboard of your financial reporting package. So for example, for revenue growth, if I want to increase revenue by 10%, I may keep a KPI comparing year-over-year growth for your revenue numbers. I may track monthly sales targets and check with my sales team to see how we're doing against target, and so on and so forth. And the next step, we'll spend a little bit of time here on this on this one here, budgeting and forecasting. Essentially, when after we've done the business review and we have a solid foundation there, and we've set our top priorities and top goals for the year, then we want to get into the next section of budgeting and forecasting, essentially building out the blueprint and how we're going to allocate the resources that we have available to meet and achieve those goals. And when we think about, some people might wonder, like, what is a budget and what is a forecast? So for the purpose of our webinar today, I just wanted to make a distinction here, just so we're on the same page. So when we talk about the budget, it is essentially the plan that outlines the financial roadmap based on your specific goal, and it is for a period of time. So in this case, if we're putting together the budget for 2024, it is for the year 2024. It doesn't change, so it stays constant throughout the year. This might be the budget that it's board approved. It could be the budget that your board approved for the year. So you may have to report to your board or investors on a regular basis based on your original board approved budget, and it becomes the plan of record for your company. On the other end, the forecast, essentially, the budget is the starting point for the forecast, but the forecast updates based on your actuals and based on predictions, based on new things you're learning, based on market conditions. You may have anticipated that you had, a big pipeline and things change mid-year. So you may have to update based on that mid-year, and your forecast is going to change. Your forecast is going to look different at the end of the year. It's going to update every month based on your actuals, and you're going to adjust accordingly. Maybe you projected that, your hosting fee was going to be 2%, but for some reason it ended up being 5%, and now you have to adjust that. Sometimes it is difficult if you're using Excel, for instance, to keep track of budget versus actual, and also keep your forecast. Sometimes the budget gets disregarded. Sometimes it's not an option, like I said, because it might be a requirement by the board to keep also the budget there versus actual reporting in addition to your forecast. For the purpose of our webinar today, we'll do a little working session here, and we'll call it a plan model. So, again, it will be essentially building on your budget, which then turns into your rolling forecast. That will be your starting point for the rolling forecast. So before we get into just working session here, I do want to bring up, this is highly critical when it comes to the budgeting side of things, is having the correct accounting foundation. If you don't have the good foundation, it will be very ineffective and inefficient building out a plan, a financial model, because you don't have good actuals, historical, to rely on. You may not be certain what are my expenses. You might be estimating it based on your bank activity. I see it quite often where, there is not good record keeping on the accounting side of your expenses, your income, and it becomes quite cumbersome, and your numbers will change, will fluctuate. They're not locked. So you're not confident, and that the numbers are accurate. So I want to touch on this just for a little bit. So when it comes to having the right accounting foundation, I have a few things here. The first thing is setting up the chart of accounts and departments based on your industry. And I will have a little bit of a screenshot to show you guys what I mean by that. And then also having accrual-based accounting and closing your books timely. I'll move to the next screen because I'll talk a little bit about these things here. So in terms of having the proper chart of account structure and departments, this one here, this screenshot, it's a P&L by category. This one, it's a P&L by department. So as you can see here, my revenue streams are broken out. So I have subscription revenue, I have implementation fees, I have professional services income. You want to have that broken out on your P&L because this might have this might have different revenue recognition guidance, and also in terms of measuring profitability, measuring your MRR or your ARR, like you want to have this distinction so you can properly calculate your metrics. You want to have your cost of sales broken down, so whatever it takes to support your customer success team, any consulting, hosting, or other costs of ops. So you want to have this clearly broken out so that you can properly measure your metrics, your financial metrics. And then in terms of operating expenses, these are summarized. So like, for instance, here I have professional fees. Under professional fees, you might have legal, you might have accounting, so on and so forth. But you want to have your OpEx also clearly broken down so that when you do your budget, you're able to do accurate projections. Because otherwise, if categorizations is not accurate and you're trying to do budget versus actual, it will be challenging to try to understand performance, try to understand how you're doing against plan. And the same thing, P&L by department. In different accounting system, this might be called differently, but for instance, in QuickBooks Online, your departments will be your classes, and you want to make sure like your R&D, your sales and marketing, your G&A, those are properly broken out because that's going to drive your metrics. Like in order to calculate your metrics, you need to have these segregated separately. So you want to have that good starting point from the get-go. When we talk about accounting, cash accounting versus accrual accounting, so this is, if you guys are here for financial planning, and usually when you do financial planning, you want to be on accrual basis of accounting, because otherwise you're doing a plan that is accrual based, but your actuals are not aligned. So it's tough to compare how you're doing. So your cash accounting will be, I get cash in, I record income when I get cash in, and I record expenses when I pay somebody. But that doesn't mean that's, from the accounting standpoint, the proper way to record the accrual-based accounting. It's recorded based on when the income was earned or when the expense was incurred. So for example, if you are a subscription-based business or a SaaS business, and you have a prepaid contract from a customer, and it's $1,000 a month, and they prepay the whole 12 months, you got, say in January, you received $12,000, you're gonna record income of $12,000 under cash accounting all in January. However, under accrual accounting, you're gonna record $1,000 every month throughout the year from January through December. And that's going to give you a better picture of profitability, based on the accrual-based accounting method, which is going to align with your annual operating plan as well. I just have here a screenshot. Of course, these are made up numbers of a accrual-based P&L versus a cash-based P&L, just to illustrate how this might look. So on the cash-based P&L, we can see that the margin goes up and down. And that is because, it's not recognizing the revenue based on when we earn the revenue, when we're entitled to receive the revenue or recognize the revenue, but just when the cash is received. So it's tough to evaluate profitability here because my margin is all over the place. Same thing with my OpEx. But if we look at the accrual-based P&L, we can see that we have a gross margin that is consistent month over month. And that's because we're recognizing the revenue based on the contract period and now when the cash was received. And we want to, at least if you're doing, if you're spending the time to do your budgeting and forecasting for the upcoming year, you want to think about that. And now building the plan model. I want to touch, we'll do a little working session here, just talking about the budget blueprint, identifying some key drivers and defining some key assumptions for your plan model. So when we talk about the blueprint, we already discussed outlining your goals. So you already have your goals outlined for the year, and now you're gonna see how you're gonna allocate your resources to meet your strategic objectives for the business. Usually, just at a high level, when you're putting together a model, the things that will take the most will, essentially in terms of spend, in terms of time, I would say 90% of your time and spend will be spent on the sales budget, which is going to drive also your sales and marketing spend, and then your headcount budget. So your sales budget is going to drive your headcount budget and also your G&A personnel. And then you have some fixed expenses such as rent, utilities, so on and so forth. So when you're establishing a sales budget, you want to think about essentially, if you are generating revenue, if you have revenue already, thinking about which products are generating revenue for your business. You also want to identify the customer acquisition channels that you're using to bring in those customers, identify key drivers, and identify key assumptions. And just for a moment here, I'm going to move to a next screen here just to talk a little bit about, identify the products generating revenue and also the customer acquisition channel. Can you guys still see my screen? Yep. Do you see the Excel?
Yep.
Okay, perfect. Thank you, Lisa. So this is a really simple model here. Nothing super complicated. On more complex model, you're gonna end up with multiple tabs. This one, just for the purpose of this webinar, kind of condensed it just for illustration. Usually on in another model that is more complex, we might have people in a separate tab. We'll have the different revenue streams as as its own tab in work paper, and we will have like OpEx, operating expenses, admin, and like your sales and marketing separately. But this is really simple, which might work if you don't have anything overly complex. So in terms of revenue, I mentioned that you want to identify the different revenue streams, and once you lay that out, so you have your goals, right, of what you want to accomplish for the year. Now you're going to go into setting the roadmap. So we want to identify, the different revenue streams. In this case, we have here monthly SaaS stream 1. Let's call it subscription revenue. And you want to identify, along with that, you want to identify the channels that you're using to generate customers for that revenue stream, because that's going to drive your model. So in this case, I have different examples here of different channels. So let's just say that you have a sales-led growth motion there for your go-to-market, and you have a sales team that is generating, the team that generates the lead. So in that case, The sales team is essentially one of your acquisition channels, and they're the ones that generate the leads. And then you have to apply certain assumptions as it relates to what is the conversion rate, how many leads are getting generated, and of those leads, how many leads get converted. At the end of the day, depending on the size of your business, you might have somebody that it's managing these, the sales team might be managing the sales funnel or the marketing funnel, and then you're just ending up with the new customer number. In this case, just for illustration purposes, I have it laid out here where if we have, let's say, the sales team here, they are generating, just increase this, 15 leads per month. And then the sales cycle, in this case, is 3 months. So we could see that it doesn't generate any customers until month 3. But if we change it to 1, and let's say that this is 15% conversion rate, so 1 month sales cycle. So from the time we get a lead, we convert that lead within 30 days, and it turns into a customer. But of these 15 leads, I'm only going to convert 15%, which turns into 2 customers. So this is what's called a bottoms-up approach, where, especially with if you're doing fundraising, it will be investors will likely question, like, how do you come up with 3 customers, or how do you come up with, 50K in revenue for your starting revenue? So you want to have some sort of assumptions that leads, that for your revenue stream, how are you generating the different, generating customers there? And in this example here, there is another example here with email marketing lists. So it just kind of makes some assumption in terms of how many leads we reach out to, and how many, what is our response rate and what is our conversion rate. So it kind of makes some assumption. And initially, if you're just starting testing some of these out, you may not have accurate numbers, and you may have to tweak it as you learn. So if you had to lock a budget, you might not be able to change the budget, but then your rolling forecast gets adjusted as you learn new things from your business. As you learn that your sales team is doing much better now, and they're converting customers at 20% versus 15%. And just going back here, I mentioned key drivers and assumptions. A key driver is typically like a variable or factor that will influence your revenue generating for the business. So some key driver, like customer churn rate, customer retention rate, will impact directly your revenue dollars, sales headcount, website traffic, and things like that. Whereas your assumptions are more like a parameter that you set. So for instance, with payroll, you have payroll taxes and benefits. Usually that's 7.65% for the employer, and whatever your benefits are. So if you provide medical and other benefits for your employee, that might be 20%, 15%. So whatever that is based on based on your business, you would adjust those assumptions accordingly. And just to illustrate that, in terms of how the drivers and assumptions impact your revenue generation. So in this example here, we could see that we have sales. In this case, we have a sales team, and for every sales team, we're generating 5 customers. So we're making the assumption that our team is generating, for every team member, we're generating 5 customers per month after they're fully ramped up. So that goes into our total customers. We also have the customer churn rate. So whatever drivers here we have for the customer churn rate, whether it's 5%, 10%, that's going to impact our total customer numbers. And then for every 25 customer, we're making an assumption that we need one customer support person for every 25 customers that we have to support those customers. So in this case, this will be an assumption here where, in my model, every time I hit 25 customer, I need a new customer support person. And so if I want to increase my number of customers, then I need to increase my sales headcount. That's a driver then. And then increasing my sales headcount will depend on how much resources I have available. What is my cash runway? How much I have to spend on sales, with the resources that I have available. And then this total customer will directly dictate how much revenue I'm generating for the business. And my sales headcount and support headcount will drive my OpEx, my salaries and wages, rent, and all that. Some tips for planning your model. You could try to get very detailed, and overall, this is an overall estimate. It's not 100% accurate and would never be. So you want to strive for long-term accuracy over just trying to get to the very little detail. So you want to try to keep the detail, but also keep it as high level as possible as well. Collaborate with your team to validate assumptions. So verifying if you're able to do budget versus actual comparison, you will also be able to validate, is my output aligned with the plan? And if not, you may have to do some digging to figure out, what's off within your assumptions. You want to establish a monthly reporting cadence to fine tune and reforecast your model accordingly. The next point here, it's accountability and transparency. You could have a great plan, but if you don't have a cadence for reporting at the end of the period, you're kind of left in the dark with like the plan. How am I doing with plan? How is my cash? You might be able to just quickly do a net burn check for the month based on your cash activity, but if you don't have something in place for accountability and transparency, your planning process will be very ineffective. So you want to set a reporting cadence, and you want to have a reporting package with the KPI that you identify for your business that are relevant based on the stage you're in, the state of growth. You want to do budget versus actual analysis, a rolling forecast if possible, and then have the different reports, whether it's management reports if you're reporting to investors. Usually you want to have different reporting package. What investors need to see is different than what management will need to see. Management will need to see more detailed reporting and drilling down a bit more into your different metrics and the output a bit more than probably what the board or investor will need to see. So you want to tailor your reporting package based on the stakeholder that you are reporting to. And just some reporting best practices. Again, creating a reporting package that is customized to your stakeholder. You will have, if you kind of follow it 4-step framework, you would have identified the goal setting in the beginning with your KPIs that are relevant, and you want to set those up front. And then every month within your reporting package, you would be reporting on budget versus actual. How do you do goal against actuals, and making sure like you are on track. If you're not, talking back to your team, figuring out what what didn't go as planned, or if you need to tweak your forecast to align with any changing conditions. And again, tracking progress on a regular cadence that makes sense for your business. If you're not tracking your progress on a monthly, usually I recommend it on a monthly basis, at least. You want to make sure that you're comparing your budget versus actual, any variance analysis timely, so you can take action. You don't want to wait 3 months down the road and know that, hey, my marketing spend went up much more than I was expecting, and now my cash runway, it's only 3 months versus the 8 months that I was anticipating. Certainly not a surprise you want to have. So it's highly important to just track these closely on a monthly basis. So that's actually that's it for the presentation here. I really hope that you guys had some takeaways here. I'll be happy to take any questions that you might have. If anybody has any questions here.
This was fantastic, Stephanie. Thank you so much. I mean, really a wealth of information. One question that we get a lot is in terms of talking about the assumptions of your financials, and going from, a startup founder who's raising capital, and, you throw out a financial model and you're just like throwing darts at a board. And can you, talk a little bit about the importance of the underlying assumptions when you're sort of a startup raising capital?
Yeah, I mean, they're highly important. Of course, in the beginning, if you have historical data to back up your assumptions, that's of course the best. But initially, you may have to, for instance, if you're just launching your pilot and you don't have any churn rates, and you acquire your first few customers, you might have to make some assumptions in terms of the churn rate. But to make the financial model scalable, you do have to apply some assumptions so that you can anticipate future performance. So that will be, like, again, like your gross margin percentages, your acquisition costs, your sales headcount. But it is highly important in order to make your model scalable. And if you don't have historical data to validate it in the beginning, you want to look at industry standard to kind of validate it initially.
Right. Okay, that makes sense. Any final questions for Stephanie on this important presentation? Stephanie, are you able to share the deck with me, and I can share with everybody along with the recording?
Absolutely. Yeah.
Terrific. And I will include you on that email. So if anybody wants to reach out to Stephanie directly, ask more questions about the presentation, and or follow up and learn more about ScaleRedi services, you'll have a way to do that. So any final questions?
Yes.
Sorry, yeah, go on.
Go ahead, Faraz. Did you have a question?
Yeah, just a quick question about what to present to investors in terms of the early stage startups that they don't have any actuals and it's all forecasts. It might be a question for Lisa, I guess. What are the major things, drivers that you need to be presenting to investors in your pitch to show them that your actual or your forecasts are close to what is expected to be? And I guess my question is about the financial slide of the deck.
Yeah. Go ahead, Steph.
Yeah, no, I was gonna say, so it just depends, of course, depending on the stage you're in. So let's say you're still building your product roadmap. The metrics and drivers are gonna just tie back to whatever your current stage is for the business. So, if you don't have any actuals to show, investors obviously are not going to ask for it, but you want to have, if you are already showing, let's say, revenue for for the upcoming year in 6 months, 8 months. You just want to have a supporting build out of how you're going to get those customers, like how you're going to get those customers, and are your assumptions in line with industry standard, for like a new startup. So you want to kind of validate your assumptions based on what other businesses in like you are doing.
Yeah, I echo that sentiment. And Farad, when you're early and you've got nothing, what an investor is really looking for is your thought process. Your assumptions, as Stephanie mentioned, as per my question a minute ago, what's the size of the market? What's the opportunity with the fundraise? Where are you going from A to B? How are you going to use that capital to reach certain milestones? They want to see the vision. They want to know the market opportunity. And they want to know that you're thinking in the right way about your financial sort of assumptions of how you get there. So I think those are sort of the core things when you're early and you don't have financials to really show yet.
Thank you.
Yeah. Any other final questions?
Yes, I have a kind of personal question. So basically, starting my business is doing video services, and I have a personal Best Buy card that offers an incentive to purchase through them using the card, but I have grant funds on my business account. So how would I go about listing that as like a receipt on my while planning, like if I were to purchase with the Best Buy card and then transfer the funds to my personal account, how would I go about listing that on like accounting information?
So if I understand correctly, Trisha, it sounds like you have some grant funds, you're using your personal card, and you're looking to perhaps get reimbursed from the grant funds. So essentially, for that on the accounting side of things, you would want to do a reimbursement from the business. So you want to have a reimbursement with the receipts as a backup. And when you do that transfer, you want to make sure your total reimbursement amount matches that amount, and just keep it for record keeping purposes. I hope that answered your question.
Okay, so yeah, so basically just keep receipts of everything for sure. But yeah, I just didn't know if I should do that at all or just use basically the actual business account to buy it, or because they offered the incentive to give me more cash back from my Best Buy account. So that's why I want to use it, because it will end up making the product cheaper. But yeah, so.
Got it. I mean, a reimbursement, personal reimbursement from the business, if it is a valid business expense, it's fine as well.
Thanks for the
Thank
question, Trisha.
Thank you, Trisha.
Any final questions for Stephanie? All right. Well, once again, Stephanie, we are so grateful for you to join us for our November partner webinar. Appreciate you being a partner and all the work that you do to empower startup success. Our missions are certainly aligned there. And thank you all for joining. Please follow Next.law, or our website is Next.law. Follow us on LinkedIn, Next powered by Shulman Rogers. Sign up for our alert. We have monthly events going on at all times of all different topics that are super interesting, and lots of information that's always circulated, lots of free resources on our website. So we look forward to seeing you all next time, and have a great rest of your day. Thanks so much.
Thank you for having me, Lisa. Take care. Thank you, everybody.